All right, you're going to want to hear this. Seriously, whatever you were doing, just pause for a second. Because the last few days, absolutely wild. We've seen a series of huge financial stories just detonate. And believe me, they are rewriting the investment playbook as we speak.
Yep, you heard that right. 5, count them, 5 financial bombs have just gone off. And we're going to break down every single one of them. What happened, why it matters, and most importantly, what it means for your wallet.
First up, we've got this jobs report that is so weird, it's got the smartest people in finance just scratching their heads.
Then boom, the Supreme Court basically hits the pause button on a $200 billion decision, and now all of Wall Street is just holding its breath.
And if that wasn't enough, big tech just made this massive, almost unbelievable bet on a really surprising energy source to fuel the whole AI revolution.
Meanwhile, you've got this iconic 159-year-old store, a giant in the retail world, and it's teetering on the edge of just disappearing forever. So, what we're going to do is tie all of this together. We'll look at the risks, the opportunities, and figure out what's really going on. Ready? Let's get into it. All right, first up is a real head-scratcher. I'm talking about the December jobs report. Because when you look at the numbers, you're just left thinking, wait, what? They just don't add up. So get this. The big headline number, it was a total shocker. The economy only added 50,000 jobs. The experts were expecting 73,000. I mean, that's not just a miss. It's the weakest hiring we've seen since 2003. So you'd think, okay, the job market's hitting the brakes, right? Well, not so fast. And this is where it gets really weird. This is the paradox. Even with that terrible hiring number, the unemployment rate actually went down to 4.4%. So, how does that work? How can you have fewer jobs being created, but at the same time, fewer people are unemployed? It feels like it breaks the laws of economics, right?
Well, the answer, it turns out, is all about the labor supply, or more accurately, a shrinking labor supply. See, fewer people are actually looking for work right now. That means the break-even number, the amount of new jobs we need just to keep things stable, has totally cratered. It used to be around 100,000 a month. Now, it's just 40,000. So the big takeaway here is that in this bizarre new environment, adding just 50,000 jobs is actually enough to push unemployment down. Crazy.
And this brings us to what's being called the new reality. Heather Long over at Navy Federal Credit Union, she nailed it. She called it a jobless boom. It's the perfect description for this strange economy. And you can bet this is giving the Fed a major headache. It's such a mixed signal that they're probably just going to sit on their hands for now, but you know they're still leaning towards cutting rates later this year.
Okay, let's move on to our second flashpoint. And this one is a potential earthquake for the markets. We're talking about a Supreme Court case that has a whopping $200 billion hanging in the balance.
So here's the deal. The whole case boils down to this. Can the president just impose massive tariffs on his own? Everyone on Wall Street was geared up for a decision back on January 9th, and then nothing. The court totally punted. So now every single trader has their eyes glued to the calendar for the next possible announcement day.
And you really need to understand the stakes here, because this is a fork in the road with two completely different destinations. On one hand, if the court strikes down the tariffs, wow, importers could get a check for $200 billion in refunds. Think about that. That's a massive flood of cash into the economy, it would cool down inflation, and it would give the Fed a green light to start cutting rates. But if the court upholds the tariffs, the complete opposite. That money stays locked up, inflation stays stubborn, and any talk of rate cuts gets pushed way, way out. It is a true 50-50 coin flip with huge consequences either way.
So yeah, circle the date on your calendar. January 14th. This could, without a doubt, be the single biggest thing that moves the market in the entire first quarter. No joke.
All right, let's shift gears. We're going from the courtrooms in DC to the server farms of Silicon Valley. Because while everybody's obsessed with AI software, the real story, the trillion-dollar story, is what's going to power all of it. And you might be surprised to hear that big tech is going all in on nuclear.
And when you think about it, the logic is actually pretty simple.
1, the AI boom needs a mind-boggling amount of power. I mean, way more than anyone expected. 2, the tech giants, Meta, Google, Amazon, are in a flat-out race to get that power before their competitors do. And 3, they're all realizing that nuclear is the only game in town for reliable, 24/7 power at the scale they need. It's the only thing that works. And the scale of this, it's just hard to wrap your head around. Meta alone just signed deals to buy 6.6 gigawatts of nuclear power.
To give you some perspective, that is more electricity than the entire state of New Hampshire consumes. This isn't some side project. This is a fundamental, structural shift happening right before our eyes.
And who better to explain why than the guy at the center of it all? NVIDIA's CEO Jensen Huang put it perfectly. He said, AI computing demand is going through the roof. It's as simple as that. The companies that lock down their power supply now are the ones who are going to win the AI race tomorrow. This is an investment theme that's going to play out for decades.
Okay, for our next story, we're coming back down to earth and looking at a pretty scary warning sign from the American consumer. We're talking about Saks Fifth Avenue, an icon, 159 years old, and it could be just hours away from completely collapsing.
So the company's desperately trying to file for Chapter 11, to reorganize. But if they can't get the financing, they get pushed into Chapter 7 liquidation. And let me be clear, Chapter 7 is the end. It's not a comeback story. It means they shut the doors, sell off everything for parts, and the company is gone. Forever. That landmark store on Fifth Avenue? Boarded up. It's over.
So you might be thinking, okay, I don't shop at Saks, why should I care? Well, here's why. This is the classic canary in the coal mine. Think about it. Saks serves the wealthiest customers, right? The people who are supposed to be untouchable, even in a recession. So if they're cutting back on spending so much that a giant like Saks goes under, what does that tell you about the health of the rest of the economy? It's a huge, flashing red light. Okay, so let's pull all this together. We've got a bizarre jobs market, a massive court decision hanging in the balance, a tech power grab, and a huge consumer warning sign. It's a lot. So the big question is, how on earth do you invest in a market like this?
Okay, let's talk stocks and real estate. For equities, the first 5 days of the year were positive, and historically, that's a really bullish sign. But, and this is a big but, that Supreme Court ruling is the ultimate wild card. This is not the time to be taking on too much risk. Over in real estate, we're seeing this new $200 billion mortgage bond purchase. That's going to give the market a nice little sugar rush in the short term. The risk, though? It could just pump home prices right back up without actually making houses any more affordable for people.
Now, what about commodities? Well, for precious metals like gold and silver, the fundamental story is still really strong. You've got a cooling job market, which points to the Fed cutting rates eventually, central banks are still buying it up by the truckload, and there are real supply issues. It all points higher. For energy, that nuclear story we talked about is a massive long-term catalyst. But in the short term, you'll want to keep an eye on Venezuela, because any changes there could really shake up the global oil supply. And last but not least, crypto. Right now, Bitcoin is kind of stuck in a holding pattern, just bouncing between 85 and 95K. The ETF flows have actually turned negative for a bit. Seems like the big buyers are on the sidelines, waiting for a new reason to jump in. The most important thing to remember here isn't trying to predict which way it'll break. It's managing your position size. That's way more important than being right on the direction right now.
So here we are. We are absolutely at a major inflection point. You've got the Fed on pause, a game-changing court decision just days away, and AI completely rewriting the rules for tech and energy. The choice is made in the next week or so, by the courts, by the Fed, by these huge companies. They're going to echo through your portfolio for the rest of the year. So the final question is, in all this noise, where's the next real signal going to come from?